Are we ready for the looming changes in the housing market?
Today, we're breaking down the Federal Reserve's monumental rate cut and its potential effects on homebuyers and investors alike.
You'll get all the crucial insights quickly, saving you hours of research.
We're also unveiling alarming trends regarding low-income consumers and their financial struggles.
Welcome to Financial Insights in Minutes, where we summarize the top real estate market insights.
And coming up next, we have crucial insights from Mitch Beckler about the looming job market collapse due to aggressive rate cuts.
Time to navigate through these waters. Buckle up as we unpack the Federal Reserve's monumental decision to cut interest rates for the first time since March 2020.
That's right. This monumental change isn't just theoretical. It's like a seismic shift that could affect everything from the stock market to your savings account.
What's really behind this rate cut?
The core thesis is that the Federal Reserve believes inflation is stabilizing enough to warrant a rate cut, indicating a shift in their economic approach moving forward.
Let's break down the first key point. What do we know about recent inflation?
Inflation shot up by over 21% since early 2020. However, it recently only grew by 2%, signaling hope. Yet, core inflation remains stubbornly high at 3.2%, largely driven by surging housing costs.
What's happening in the jobs market?
Recent data shows a dramatic decrease in job availability, hitting the lowest since January 2021, with the smallest payroll growth in 3 years. This suggests a notable cooling in hiring.
Now, let's discuss the stock market's response to these cuts.
Historically, rate cuts indicate trouble ahead, often leading to market drops. However, the interplay between cuts and market health is complex. It's not just about lowering rates.
What are the predictions following this rate cut?
Analysts predict more rate cuts as the Federal Reserve seeks to stabilize the economy, taking a proactive yet cautious approach.
In summary, what's the overall take from all this?
The Federal Reserve's interest rate cut reflects cautious optimism about economic stability, but the real question remains, how will these changes impact the housing and stock markets moving forward?
But wait, there's more. Up next, we have the CEO of Dollar General issuing a big economic warning. Trust me, you won't want to miss it.
That's right. Prepare for insights that could change how low-income families are coping in these turbulent times.
Navigating through the turbulent waters of today's economy, the Dollar General CEO has issued a stark warning about low-income shoppers running out of money. What does that mean for the retail landscape?
Indeed. The core message reveals an alarming trend. Dollar General's clientele isn't just struggling, they are barely staying afloat as inflation bites. Let's dive deeper into these critical insights.
So what's the big takeaway from the Dollar General CEO's insights? Why are these dollar stores witnessing a downturn?
Simply put, low-income consumers, the core of Dollar General's market, are increasingly unable to afford even the basic essentials. These dollar stores, once viewed as a safe haven for budget shoppers, are becoming unaffordable.
What about their store dynamics?
Dollar General, while having the largest footprint among retailers, is losing its charm. Shoppers, particularly those earning less than $35,000, can no longer find deals, making affordability a significant concern.
What are the overall economic conditions for consumers?
A savings rate dropping to 2.9% reveals a precarious situation. This resembles 2007, the calm before a severe storm, highlighting that many Americans are living paycheck to paycheck.
What's on the radar?
Job openings are now at their lowest since early 2021, raising real concerns. Historically, when the Federal Reserve cuts rates, downturns follow swiftly, indicating a rising risk of recession.
What do the predictions for the job market look like?
Expect layoff numbers to continue rising among lower income brackets. This instability could further weaken the economy, triggering a downward spiral.
Are we in for a turbulent economic ride?
Yes, both the stock and housing markets are at an all-time high, but they might soon fluctuate. With inflation rising and consumer spending declining, the potential for a market crash looms larger every day.
What should we take away from these concerns?
The consumer landscape is shifting dramatically. We face potential crises ahead. Addressing wages, inflation, and retail strategies is critical to stabilize economic prospects.
What's next on the agenda?
Watch closely as the housing and retail markets evolve. Opportunities may arise from the upcoming changes in the job landscape and consumer spending. Stay informed.
But hold your horses. Up next, we'll get insights from Mitch Beckler about the upcoming IBM layoffs, job market collapse, aggressive Fed rate cuts.
You won't want to miss his take on the critical shifts in the job market. Stay tuned.
Ready to navigate through turbulent waters, our next insightful summary digs into the job market and the Fed's recent drastic measures.
Exactly. Mitch Beckler is here to provide clarity on job losses and aggressive rate cuts, bringing a wealth of knowledge in financing and market strategies.
What's the core argument in this summary?
The crux here is how the Fed's drastic rate cuts are an urgent response to a rapid collapse in the job market, impacting everything from interest rates to municipal financing.
Breaking down key points, let's start with mass layoffs. What's happening?
This month, IBM initiated stealth layoffs affecting thousands of workers. Wells Fargo and General Motors are also cutting jobs significantly, raising alarms about employment stability.
Moving on to the Fed's actions.
The Fed's 50 basis point cut aimed to stabilize the economy, but paradoxically, mortgage rates actually increased, indicating complexities beneath the surface.
What's brewing in local economies?
Municipalities are on the brink of collapse due to soaring debt, which taxpayers will likely feel as local services start to suffer.
What predictions did Mitch share regarding job losses?
Continued layoffs are expected, raising unemployment rates. The impact on local economies will worsen as large corporations scale down operations.
What about inflation?
Inflationary pressures will persist, with both wages and goods becoming more expensive, creating a cycle of economic distress.
So, what's the bottom line from all this?
Intelligent policy responses are crucial to stabilize the job market and ensure local governments don't collapse under debt. There's an urgent need for real solutions moving forward.
But wait, there's more. Next up, what is equity stripping? We'll unpack this critical issue with Mitch Beckler.
You won't want to miss this crucial conversation that links personal finance to the wider economic landscape.
Let's navigate the currents of today's discussion. Let's dive right into the shocking revelations about the housing market, particularly the unexpected costs of title insurance.
Here's the full report. Today we have Stacey Mayer, a seasoned real estate broker with over 30 years in the industry, shedding light on how a few tweaks can make homeownership more accessible.
What's this big idea at the center of Stacey's claims? What about title insurance?
The core thesis is centered on eliminating mandatory title insurance, allowing buyers to save thousands in closing costs. Stacey argues this could reshape how we approach home buying while addressing significant systemic inefficiencies.
Let's unpack key insights on title insurance. What's its role in home buying?
Title insurance protects against claims on property ownership, but it significantly raises closing costs, often burdening buyers from the start.
What about those hefty cost savings Stacey is excited about?
By switching to attorney opinion letters instead of title insurance, buyers could save thousands of dollars at closing. It's a refreshing approach.
What kind of disruption are we talking about?
Stacey's model aims to disrupt traditional real estate transactions by introducing an attorney-led process, streamlining costs, and increasing clarity, providing an enticing alternative to title insurance.
Stacey's vision is bold. What about future predictions?
There's strong potential for further adoption of alternatives to title insurance. As more lenders accept attorney opinion letters, we could see a significant reduction in overall home buying costs.
What else should we be watching out for?
As consumers become more aware of these options, there's likely to be heightened pressure on legislators to reconsider outdated title insurance mandates, pushing towards a more consumer-friendly market.
What are the implications for home buyers?
In summary, embracing alternatives to traditional title insurance could catalyze significant savings for buyers while paving the way for an evolved housing market prioritizing buyers' needs.
And what should viewers keep in mind moving forward?
Anticipate ongoing discussions about unnecessary fees in home buying as this conversation evolves and more initiatives like Stacey's take the forefront.
But wait, there's more. Up next, we'll hear from Ken McElroy on the best real estate deals always have this in common.
Don't miss Ken's golden insights to elevate your real estate investment savvy.
In today's fascinating real estate summary, we're uncovering what truly makes the best deals shine. we have Ken McElroy sharing his wealth of experience in property investment.
Absolutely. Ken has been in the game for over 30 years and knows precisely how to spot opportunities. Every great deal must tell an engaging story.
So what's Ken teaching us about successful real estate?
The thesis is clear. The best real estate deals center around a compelling story that potential investors can easily understand.
What happened at that senior community?
Management faced a lack of occupancy. By repackaging pricing of the first floor units, Ken turned a $400,000 revenue shortage into income.
What about the condo project he mentioned?
Here, Ken bought a fourplex for $450,000 and flipped it into condos for an impressive total of $800,000, a net profit of $250,000. Talk about a savvy move.
Ken emphasizes that storytelling is crucial for success, right?
Exactly. Investors need clarity. A compelling story reduces confusion and fosters confidence in the deal.
So looking ahead, how will storytelling shape future investments?
Ken predicts a growing emphasis on communication strategies focusing on simple yet impactful narratives to attract investors.
To summarize, Ken McElroy teaches us that compelling stories are the backbone of real estate success.
Absolutely. It's all about clarity and engagement. And here's the kicker. These summaries are just the tip of the iceberg.
What's Ken's final takeaway for us?
Ken insists on the need for clear communication over complex data. If it doesn't have a story, it might be a gamble.
If you found these insights valuable, don't forget to subscribe for more help and tips.
By subscribing, you support the channel and ensure you receive all future updates. Let's keep your investment journey thriving.
What a riveting discussion today about the recent Federal Reserve rate cuts and their potential repercussions on the housing market.
Absolutely. Graham Stephan highlighted how these cuts could reshape home buying strategies, while others like Mitch Beckler pointed out their risks to job stability.
And let's not overlook the challenges faced by low-income consumers, as discussed by the Dollar General CEO and other experts.
Indeed. It's clear that while some see opportunity in real estate, others are cautious about market signals and increasing inflation.
Thank you for tuning in to Financial Insights in Minutes. If you found value in today's discussion, don't forget to like and subscribe for more insightful content.
And be sure to check out our other videos for even more strategies to navigate the ever-changing economic landscape.